This is Al Brooks. Thank you for watching the Brooks Trading course. This is the 5th of 5 videos on trends. In this video, I'm going to be talking about tight channels, which are strong trends, and I'll also talk about small pullback trends, which are the strongest types of trends. Sometimes you see a trend like this, we've got a spike up and then a channel, and it's difficult to know if this is still part of the breakout phase or if it's part of a channel. On a higher time frame chart, it is part of a breakout. And if it's difficult to tell whether it's a breakout or a tight channel, assume it's a breakout and trade it like a breakout and only look to buy. Because it is a breakout on a higher time frame chart. It's clearly a bull trend, so you should only buy. Can you sell? I would only buy. Whenever the market is in a fairly tight bull channel, it's a breakout on a higher time frame chart. It's much easier to make money looking to buy. The odds of making money as a bear are small, so better only to look to buy. So let's say this is a 5-minute chart, and it's a fairly tight bull channel. A tight channel is weak compared to a breakout, but it's still a pretty strong bull trend. The pullback only lasted 1 bar. Pullback only lasted 1 bar. Here, no pullback at all. Even if you do get a reversal, it's probably minor, and you're probably going to get at least a little bit more up. So I think of a tight channel as a strong trend, and I trade it like a breakout. And as I said, on a higher time frame chart, it is a breakout. So for example, 5-minute chart, this green box here. This green box is the same bars, but this is a 15-minute chart. And it's clearly simply a strong breakout, and you don't want to be selling. So you only want to be trading in the direction of the breakout. Tight bear channel, the pullbacks are small, they're not going very far up, and the channel down is very tight. It's a breakout on some higher time frame chart. There are always different ways to draw the channel. This is one way. You can also draw it that way as well. And it does not matter. When the pullbacks are small, you only want to be looking to sell. And here we get a gap this low, these highs. The market's forming gaps. You only want to be selling. And if you want, you can sell with stops on reversals down. So you wait for a reversal up to fail, and then you keep looking to sell below the low of the prior bar, betting that the bull reversal will fail, and that the bull reversal, in fact, will simply be a bear flag. Here, you sell. Does not matter if this goes above that. We're still forming lower highs, major lower highs. This is a minor lower high, minor lower high. So it does not matter that we go above it. Traders should only be looking to sell when the channel is this tight. It's a breakout on a higher time frame chart, so you only look to sell. And these gaps that we're getting are a sign that it's a very strong bear trend, and you should not be buying. Bull breakout, a channel. We have pullbacks, we have some bear bars, but the pullbacks only last a bar or so, and they do not fall very far. And on a higher time frame chart, it's a breakout. Many ways to draw the channel. This is one way, and you can also draw it like that. And the channels, they're never perfect. They're rarely perfect. Doesn't matter. When the channel is very tight like this, only look to buy. Every time you see a reversal attempt, expect it to fail and become a bull flag, and then buy with a stop above the high of the prior bar. Gaps, we have a reversal attempt, but the low of the reversal could not fall above the high of the breakout point. Again here, bull breakout, tried to fail, tried to reverse here, but these bars held above the breakout point, and that is a sign of a very strong bull trend, so you do not want to sell. This is unlike a broad channel where the pullbacks last 5, 10 bars or more, and sometimes the breakout is strong enough to make the market always in short. So we get a big breakout bar and a follow-through bar, probably always in short, but we're still getting higher lows, and this still could be a broad bull channel. A broad channel like this, to me, is basically a trading range that's sloped upward, and you can trade both as a bull and as a bear. But because it's a bull trend, in general, it's easier to make money buying. It's also a pair of trading ranges. We had a trading range and then a breakout in another trading range. And that's often the case. That's usually the case whenever the market's in a broad channel. It's usually also spending a lot of time in trading ranges. Trading range, two-sided trading, traders tend to buy low, sell high, and scalp. So whenever the market is in either a trading range or a broad channel, traders will often trade in both directions, and they'll take quick profits because they believe the market's not going to go very far. So they buy low, sell high, and scalp. So whenever the market falls somewhere in the middle third, they look to buy. Anytime it goes to a new high, they look to sell. And they take quick profits because they believe the market's not going to go very far. So you got a bull channel. Is it tight or broad? Well, sometimes you're in that gray zone where you don't really know. Here we got a 2-bar pullback, well, 1-bar pullback here, 2-bar pullback here, a little trading range here. Is it a tight channel or is it a breakout? On a higher time frame chart, it's probably a breakout. But whenever I'm looking at any chart and I'm deciding broad or tight channel, I always assume tight, and therefore I only want to look to buy until there's more evidence that the market is two-sided. If you cannot tell broad or tight, only look to buy, like in this example. So every time the market tries to reverse or pause, look to buy with the stop as the market reverses up. Small pullback trend, the strongest type of trend. And it usually is also some other type of trend as well, like a trend from the open, a spike in channel trend. A lot of times there are small trading ranges, so it's a trending trading range day. And the pullbacks, I said it's a small pullback trend, so the pullbacks are small. They typically do not fall very far, and they typically do not last for many bars. So 1 bar here, 1 or 2 bars here. We're getting reversal attempts, and a lot of the rally in a small pullback bull trend looks like a bull leg in a trading range. You're not getting consecutive big trend bars. You're getting bars with a lot of hesitation, tails on top, bear bars. And that is a warning that either it's a bull leg in a trading range, or if you're starting to get gaps or negative gaps, pullbacks just dipping a little bit below breakout points or not dipping below at all. Even though it looks like a bull leg in a trading range, it's probably a small pullback bull trend, and it's probably going a lot higher. So a pullback's just lasting a few bars, no consecutive big bear bars. The pullbacks are all less than twice the size of an average bar. While any type of trend can begin any time of the day, small pullback trends usually begin in the first hour or so. And again, the pullbacks are less than twice the size of an average bar. And one of the most important characteristics is gaps and negative gaps. So once you start to see a rally that looks weak, it lacks consecutive big bars, but it's forming gaps, you got to be thinking, uh-oh, this is one of those small pullback trends that Al talks about, and it's one of the strongest types of trends, and therefore I should only look to buy. And these trends are breakouts on higher time frame charts. So here's a 5-minute chart, small pullback bear trend, and this is what it looks like on a 30-minute chart, a higher time frame chart. Almost all bear bars, mostly a bear microchannel, so it's a bear breakout. Each of these pullbacks means that it's a channel on the 5-minute chart, but the absence of pullbacks on the 30-minute chart means that it's a breakout. Because this channel is a breakout on a higher time frame chart, the 5-minute chart is much stronger than it appears. A breakout is the strongest type of trend, and it usually leads to some kind of a measured move. If you have a small pullback bear trend, you know it's a breakout on the higher time frame charts, and you know it's therefore one of the strongest types of trends, even though most of the time it keeps looking like it's a bear leg in a trading range. These gaps that I talked about are really important. They make it likely to be a small pullback bear trend rather than a trading range. So look at this. We got a breakout here below this breakout point, did not overlap. And we got a breakout here, did not overlap. The pullbacks are not going over the breakout points. And that is one of the hallmarks of a small pullback trend. If you're getting gaps, especially if you get 2 or 3 gaps, that's a warning that even though each little part of the trend looks weak, it's a very strong trend and the market's probably going a lot lower. So do not look to buy. You certainly don't buy until you start seeing some transition into a trading range. You need to see some sign of strength on the part of the bulls. The bulls need to start closing gaps, like here. A breakout point, here's the breakout point, the pullback went above the breakout point. So maybe the market will soon begin to transition into a stairs pattern and then a trading range. In these very tight bull channels, small pullback trends, the market's always trying to reverse, but the breakouts will fail and become bull flags. And usually later in the day, after 3, 4, 5 hours of trading, if you're trading stock index futures, a lot of times around 11 o'clock, 10 o'clock, sometimes 12 o'clock, but usually around 11 o'clock, 11:30, you get a breakout that is 50% to 100% bigger than the biggest prior breakout. So here's the biggest prior breakout, and then here we got one that's about 50% bigger. And it's an attempt by the bears to take control and reverse the market late in the day. But chances are the bears will fail and the reversal attempt will become a bull flag. And a lot of times it goes up to a new high at the end of the day. We have a very strong breakout, another breakout, and then a very small pullback bull trend. You can call it simply a tight channel. Sometimes you get a bigger reversal late in the day. This is so extremely climactic, it's not a surprise. And sometimes you get a sell-off into the end of the session or into the close of the day. Here we're sideways for 20 or 30 bars, and now we got a double top major trend reversal, and we just sold off slightly into the close. Sometimes you'll get these small pullback trends, and they actually will reverse. Here we got a spike and channel, so maybe a parabolic wedge, 1, 2, 3, nested 1, 2, 3, and then you start to get an endless pullback in a tight channel like that. You're going to be thinking that the market might be seeing this as a parabolic wedge, and if it does, a lot of times you'll get a breakout after 20 or 30 bars, and then you convert into a bear trend. We got a bear breakout, bear follow through. You can say, well, Al, these are gap bars. There's a gap between the high of the bar and the moving average. Won't that lead to a test of the bull trend high and then a major trend reversal attempt? Well, it typically does, except that this endless pullback in a tight bear channel has gone on for 20 or more bars, and that's making the market pretty neutral. So this bull reversal may not get very far. You can see the bad follow through in the market failing to break strongly above the moving average. Is it now a small pullback bear trend? Usually I don't think of it that way. So I think of a small pullback bull trend and then an endless bear pullback. But to me, this is a real problem for the bulls. This is so climactic, unsustainable. And now we have an endless pullback and a bear breakout and a reversal up, could not get above the top of the bear breakout. This might be the start of a bear trend, this bear breakout bar. So you got to be ready if the market starts to sell off, especially once you get another bear bar and a bear follow through bar. Traders start to sell closes and they sell above bull bars, betting the reversal up will fail. Usually, if you have a small pullback bull trend, you do not get a reversal. This is really more of a spike and channel bull trend or a parabolic wedge bull trend and less of a small pullback bull trend. I typically don't call this a small pullback bull trend, although it clearly is. To me, it's just so climactic and so extreme. I think of it more as a biclimax. Remember, I said that small pullback bull trends, typically they have weak bars, a lot of doji bars, prominent tails, bear bars. It looks like a bull leg in a trading range. That's not the case here. This is much more of a parabolic biclimax, parabolic wedge biclimax. This is more of a small pullback bear trend. We got a lot of bars with tails. We've got some gaps. Does not look especially strong. No big bear bars. We're getting bad follow through bull bars. But here we got a bull breakout and a higher low. So it's possible that this is a higher low major trend reversal. And this is maybe a final bear flag. Low too short, 2 legs up, 1 pullback 2. So a low too short and a wedge bottom. And then a higher low major trend reversal. So possible start of a reversal up, which we got. Less common after a small pullback bear trend, but you still can get it. Higher low major trend reversal. Some will say this is the higher low major trend reversal. This is a double bottom with this bear bar. Other computers will say the double bottom is here. So it's a double bottom, higher low major trend reversal. Small pullback trends are also tight channels. That only makes sense, right? If the pullbacks are really small and the market is trending higher, it's going to be in a tight channel. Pullbacks are usually less than 2 to 3 times the size of the smallest scalp. Here we have a bigger pullback late in the day. Usually it fails and you get trend resumption up. And you redraw the channel. So we have a tight channel here. We broke below it. And now the market's resuming up. You redraw the channel and the distance between the lines is now greater. Channels as they mature, trends as they mature, typically become weaker and the channels tend to become broader and flatter. So flatter, the slope of this new channel is less than the slope of this original channel. Whenever you think the market might be in a fairly strong bull trend, do not sell. Here we got a bull breakout. Do you want to sell for a failed breakout? I would not. Not yet. A lot of the beginners like to sell in bull trends because the stop is close, but they ignore probability. And whenever you're taking a trade with a low risk, a small risk, chances are you're going to lose. The probability is going to be low. And if you get enough of those small losses, 3, 4, 5 small losses, it can add up to a pretty big loss. So whenever you're in a market where the pullbacks are very small, even if you see a lot of weak looking bull bars, do not sell because on a higher time frame, it's a bull breakout. So if a trader sells here, he gets stopped out. Trader sells here, he gets stopped out. Trader sells here, probably will get stopped out. A lot of bulls are afraid to buy because the rally looks weak. Tight trading range with dojis, bull bar bad follow through, bull bars with dojis, the bull breakout not all that big. So bulls end up getting trapped out. At least weak bulls do because they know where their stop is. The stop is way down here, so they don't want to be buying too far up in a rally that looks weak. But if the market is forming gaps and not much in terms of bear bars, it's perfectly good to buy for any reason and just use the appropriate stop. Beginners, they just look at the dojis and say, oh, strong bull trends do not have all these dojis, so it cannot go higher. In general, that's true. Breakouts do not have all those small dojis, but small pullback bull trends, they do have a lot of small dojis, and the market is in one of the strongest types of trends. You don't want to be selling. The wider the stop you use on any trade, the higher the probability is that you make money. When you do lose, you obviously lose more than with a tight stop. But as a general rule, if you use wide stops, you're increasing your risk, but you're doing that to increase your probability. So wide stops usually mean higher probability. Tight stops usually mean low probability of making money. So you know where the stop is. Initially, it's down here. And then you see a bull breakout or somewhere up here, you raise the stop to here. After you see 3, 4, 5 bars up, strong breakout, this becomes a major higher low, so you raise the stop. The strong bulls, they see the doji bars and they see the bear bodies and they know the trend does not look all that strong, but they also recognize it as a small pullback bull trend day. They see gaps and negative gaps with a lot of trading range price action, and that usually means the market is going to go higher, small pullback bull trend. And they buy for any reason. You can buy reversals up from bear tops, you can buy stop orders, you can buy at the market. And then every time you get a reasonably strong breakout, especially with follow through, you tighten your stop to just below the breakout or just below the most recent higher low. Strong breakout, move the stop from here to there. Bulls buying above these bars, betting on a bull flag. Once you get this breakout, you raise the stop, and this becomes a major higher low. Major because it has both decent bull bars and it's a new high. One other thought about this is the best looking bull bar, probably. We got one comparable here, but certainly one of the best 1 or 2 bull bars, and it's occurring late in a bull trend. So that's an increased risk of exhaustion. Exhausted bulls do not necessarily sell enough to create a short, a bear trend. Usually they do not. However, they usually do sell enough to create a trading range. So if you start to see a surprise bar like this late in a bull trend, 30, 40, 50 bars, it's an opportunity to take profits. Sometimes when you get these small pullback bull trends, they stay above the average price for a lot of bars. This is maybe 30, 40 bars above the moving average. That means bulls are really aggressive. They're willing and eager to pay above an average price for 20 or 30 bars. So what do you think will happen when it finally gets down to an average price? Well, the bulls will buy. They've been buying above an average price for a lot of bars. So if they finally get a chance to buy at the moving average, they usually take it. Also, whenever the market's above the moving average for about 20 bars or more than 20 bars, I think of it as a 20 gap bar buy setup. And a lot of bulls will place limit orders to buy the moving average, at least for a scalp. Also, a lot of bulls will look for the first bear close below the moving average, and they'll buy that bear close, betting that it's a trap. And it usually is. So here you have a 20 gap bar buy. You can buy the moving average or place a limit order buy 1 tick above. Or you can buy these gap bars, betting that the trend is so strong, we will resume up to a new high. Bulls, as I said, try to buy the first bear thing. So the first time there's a pullback below the low of the par bar, they buy it. First time there's a break below a minor higher low, they buy it. First test of the moving average, they buy it. First bear close below the moving average, they buy it. First big bear trend bar below the moving average, they buy it. Gap bars. As soon as they see bars with a gap between the high of the bar and the moving average, they buy. They can either buy the gap bar or they can buy the reversal back up using a stop. And here we have a moving average gap bar, a gap between the high of the bar and the moving average. So bulls will buy on a stop just above the high of that bar. And even though we're getting a lot of sell-offs here, we're still making higher lows and higher highs. Gap bars, it's a sign that the bulls are losing control, and it's a sign of strong bears. They're able to put a bar completely below the moving average. So when you get gap bars in a bull trend that's going on for 2 or 3 hours, the rally that follows the gap bars usually will be the final rally before the market attempts a major trend reversal. E-mini, trend from the open bull trend, very strong bull breakout, pullback, and then we're just moving up. Again, when it's this strongly up, I tend to think of it more as just a breakout and an extended breakout on a higher time frame chart. I also am aware of the possibility that it could be a parabolic wedge top. Small pullback bull trend, also a trend from the open bull trend, and spike and channel bull trend. So spike, pullback channel, or the whole thing is a spike, pullback channel. Again, most trends have a spike and channel trend within them. First pullback in about 15 bars or so. Bulls will buy it, and pullback, you're going to be thinking that the channel will follow. And here we got a 14 tick pullback, and the first pullback to the moving average in about 50 bars. Small pullback bull trend. You always look for a bigger pullback later in the day, usually about 50 to 100% bigger. Here we got a 14 tick pullback, and here we have a 31 tick pullback. A lot of bars that do not look particularly bullish. A lot of small bars, a lot of dojis, a lot of prominent tails, a lack of consecutive big bull bars closing on their highs. One of the characteristics of a small pullback bull trend. And then, most importantly, in addition to seeing weak bars, I want to see gaps, at least one or two. A pullback held above the breakout point, and again here, that's a sign of very strong bulls, and it increases the chances that we'll get some kind of a measured move up. In fact, here, measured move from the bottom of the bull trend to the top of this rally takes us up to about the high of the day. So from the low of the day to this breakout point, measured move up. This is the euro versus the Canadian dollar, and this is the approximate start of the Asian session, and it began as a small pullback bull trend. A lot of weak-looking bars, dojis here, not particularly big bull bars here, a lot of reversal attempts, but it's still a small pullback bull trend. A lot of dojis common in small pullback bull trends. But look at the size of the pullbacks. 13 pips, 17 pips, 22 pips. They're all pretty small. The entire rally went up 115 points, and the biggest pullback was only 22 pips. So very small pullback in the bull trend. A lot of dojis, a lot of prominent tails, the absence of consecutive big strong bear trend bars. You have to be thinking about small pullback bear trend. Next, you look to see if there are gaps. And if there are gaps, the day is probably a fairly strongly bearish day. I always measure the size of the pullbacks. So 17 pip pullback here, 19 pips here, 14 here. And here we fall 140 points. And the biggest pullback was only 19 pips over here. Again, lots of dojis. It looks like probably a bear leg in a trading range. But once you start to see gaps, you got to throw out that idea of a bear leg in a trading range. And instead, you have to assume small pullback bear trend and that we're going to work lower. One of the hallmarks of a small pullback trend is gap formation. So if you start to see gaps, yet the bars do not look particularly strong, you have to assume that the market is much stronger than what you think. Again, you can see we have a gap. It became the measuring gap. And a lot of the bulls get out here, even though the market continues sideways for a couple of hours. In this video, I talked about tight channels and how they are breakouts on higher time frame charts. You only want to be buying in tight bull channels. You only want to be selling in tight bear channels. Next, I talked about small pullback trends, which are typically one of the strongest types of trends, and they can last a long time. They always look bad. They always look like they're forming legs within trading ranges. But once you start to see gaps, even if the gaps are not particularly impressive, you have to assume that it's a small pullback trend and not a leg within a trading range. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the 5th of 5 videos on trends.